Mailbag is right now sponsored by Centerguard, the only plumbing company that I trust to touch my pipes, Amy, that are in my house. So I want to start out with some how we help listeners. Okay, unfortunately, I couldn't help this listener. He wanted a HELOC. I said, okay, it's a good start. I know what you want. Lives in a $600,000 home with a $200,000 mortgage. Okay, so far so good. He's got a pension. Did you put? It sounded like you put cream in that coffee. Was that? It sounded like when you were sipping right there, Tim. That was cream. Was that cream in there? No. Okay. So we've got a retired guy who's got a second job. He's got 60 G's from his pension. He's got 20 grand from his wife's self-employed job. So we've got income, got a lot of equity. Challenge is he had 9 months without making a mortgage payment. So his credit score is at 570. So even though they didn't go into foreclosure, they are in foreclosure status, and they got caught up because he got another job, right? He retired, then found trouble. He had trouble getting a job. And then when he found the job, he was already 9 months late on his credit, on his mortgage. So his mortgage is completely blown up, and he has $80,000 worth of credit card debt. Listen to the show all the time, probably listening right now. So the point of this is, Tim, when we talk about doing financial analysis, if this guy was one of your clients, right, if this listener was one of your clients, yep, and we did the mortgage analysis and see that he was working, he doesn't have a HELOC, he could have had a HELOC in this case. He could have used the HELOC to pay his credit cards and housing expenses, not destroy his credit, not get down in the 500s, not disqualify himself from a mortgage for at least 12 months, and be in a much better position for him and his family. That's why the mortgage has got to be a key cornerstone for every future portfolio analysis that you do. Because if this listener was one of your clients, which he's not yet, right? You would have said you should have gotten a HELOC. You had the HELOC. He wouldn't have been in $60,000 worth of credit card. He would have lived off the HELOC until he found a job, which he did. And then instead of paying his mortgage company to get his home out of foreclosure status, he'd be paying down his credit card debt, right? He'd be paying down his HELOC that he used to live off of and not have a foreclosure on his credit report, which is going to be with him for the next 7 years.
Right.
Just very frustrating. So please, when we do future analysis for your clients, or when I work for you, right, or I'm part of your team, but when you do it, it's got to be a focal point, because this gentleman could have saved his home and not been in foreclosure status. So that's just one thing.
I agree.
All right. So we got that, and then we talked about the guy from Rocket had killed another Rocket deal 3 weeks in a row. Father listens. Son was serviced by Rocket. This guy called up and said they want to take me from a 15 at 6.25 to a 15 in the 4s. I'm like, it's impossible. It's not there. They're going to jam you with a bunch of closing costs, and they were. So put another bullet in another deal for Rocket. So if you're getting quoted by Rocket, they own 25% of the mortgage industry. They service 25% of the market. I don't know how that's not collusionary. I don't know how that's not anti-competitive. Not with this administration, but hopefully in a future administration, somebody says somebody owning 25% of the servicing rights is a little crazy, and they just hound the crap out of you, and they beat you down. So if you're getting quoted by Rocket Mortgage, please send me the loan estimate so I could explain what's going on. And maybe it is a good deal. Most likely it's not. And if Rocket Mortgage wants to come in here, open seat any Saturday, 10 until 1. Jobs numbers came out. Drop it there. I want to thank Fox News for the job numbers. Go ahead, Neil.
Minus 23,000. No rebound for the July jobs report. Negative 23,000. Unemployment rate drops in July to 4.1% from 4.2% in June, and the same for the expectation. The number of unemployed drops from 7.1 million to 6.9 million. Where are other jobs, Maria? Well, manufacturing, bright spot, better than expected, created 5,000 jobs in the month, but again, a disappointing jobs report.
5,000 whole jobs. So here's a fact from the Bureau of Labor Statistics, the government job numbers. President Biden's last 19 months, his administration created 2.7 million jobs. President Trump, the job creator, according to the Bureau of Labor and Statistics, these are government numbers, 542,000. Tim, you're a numbers guy. Is 542,000 greater or less than 2.7 million?
I was told there wouldn't be math today, but I would think that that's not a good number.
Okay, so there you go. So we're going into some nasty things here, folks.
Bad water.
And you better be prepared. You better be balanced. That's why you're on, Tim, and get those portfolios analyzed.
Right.
Make sure they're balanced, because I am telling you, I'm not Nostradamus here, and I'm not raining, frogs and locusts, but open your eyes and see what's going on. There are people losing their jobs left and right. Hackney's, for God's sakes, after 20.
Gosh,
Hanson's here. How you doing, Hanson? Hackney's, after 70 years on Lake and Waukegan, going out of business. Okay, 70 years in Glenview, staple, going out of business. And here, I'll leave everybody with this. America's biggest home builders are slashing prices. Lennar has reduced its average selling price from 511 G's to $377,000, nearly a 25% decline, inclusive of incentives. D.H. Horton has cut their prices nationally. This is a national basis. 415 G's down to 366,000, 12% decline. 4 years ago, this would have been hard to imagine. From 2019 to 2022, Lennar sold homes for more than $100,000 above D.R. Horton, with prices for both builders surging. Today, after 4 years of price cuts, they're selling homes for nearly the same price. Put that in your pipe and smoke it. You better be prepared for what's happening. And the indicators are not good. The job numbers are not good. The inflation numbers are not good. No matter what anybody in Washington wants to tell you, everything is candy canes and sugar cones and lollipops. Okay, talk to the people that are like I do every single day, between $30,000 and $130,000 worth of credit card debt. They're bleeding out of their ears, their eyeballs, and their nose with their debt. We got some bad things coming up, and you better be ready for it, because I went through it 3 times in this industry. 26 years last Saturday was my 26-year anniversary in this industry. I've seen the peaks and I've seen the valleys, and I've seen warning signs that we're going into another valley, and it's scary as crap. So brace for impact. That was the Center Guard mailbag.